If you were invested in the market on Friday, you probably had a rough day. But with that being said, as dividend growth investors, we're looking for days like that so that we can better position our portfolio. If you want to see how last month impacted my portfolio, as well as get some suggestions on some hot buys out there on the stock market for dividend stocks, stay tuned. Hey guys, Kevin Burgess back yet again with another video. Friday was a pretty rough day on the market, so I thought today's video we would chat a little bit about that in the context of my portfolio. So today is the actual detailed review of my portfolio, and I think that's important for this channel. I want to be totally transparent with you. So in this video, I'm going to show you not only my holdings, but what the performance was for those holdings. I'll show you the stocks that I bought, any stocks that I sold, the dividends that I received, the options transactions that I have, and just a whole litany of things that we will talk about in the portfolio. So I'm excited about that. And then I thought at the end what I would do is, out of the portfolio, point out a couple of stocks that I think are hot buys right now and that I am looking at very seriously. Obviously, I'm not a licensed financial advisor, so I can't recommend stocks, but these are stocks that I'm looking at for my portfolio that I think are good buys. And of course, you'll have to do your own due diligence around that to see if it fits in your portfolio. So I'm excited about today's video. I think there's a lot of good things to talk about. And so with that, let's get started. So just as a reminder of the 6 steps to personal freedom, if you've not seen the video I did on this, I'll put that on the end screen so that you can click on that at the end. But there's 6 steps to personal freedom, and the point that I want to make here today is not to go back through this again, but to help us realize that along the way, there are going to be times when our portfolio goes up, and there's going to be times when our portfolio goes down. And so as you look here at step 4, of course, this is simply a picture, but when we're climbing this mountain, I don't want you to get the impression that this mountain is always going to go up. There's going to be times when things go down, and then they're going to come back up. And so it's just going to be a rough, rocky climb. And so I think Friday helps us understand how to get used to that. So looking at my portfolio, you will see that for the week, the portfolio is down only $3,000, but that's pretty deceiving because on Friday, I put in $25,000 into the portfolio. I'll talk a little bit about that here in a second, but so the important part of this is that the market value of the portfolio went down $28,841.32 for the week, which is pretty alarming, man. That's a lot of money. I don't care who you are. That's a lot of money. So we went down 3.5% this week, while the S&P went down 3.3%. So pretty much in line with market. The month of April was a light month in terms of dividends, so there's only about $300 sitting there. I did close out an options position I'll mention later that closed out for $27.91. So when we look at it on a year-to-date basis, the portfolio is up by $62,000, but it's important to point out that I put in $74,700 so far. So the actual market change in the portfolio is almost down by $20,000. Now, obviously, $29,000 of that was in this week. So this is the first time all year that our portfolio has actually been negative on a year-to-date basis. Now, the interesting thing here is that the S&P is down 13.9% on a year-to-date basis. So we're saying that the portfolio is performing about 16.4% better than the S&P 500, but that still doesn't make this 2.5% and $20,000 feel much better, right? So, and if you take a look here from a dividends perspective, year to date, we've gotten $7,174 in dividends and about $450 in options transactions. So let's chat just a minute about the market move on Friday. I mean, how did you feel about that? Did that cause you to kind of doubt what you're doing? Did it cause you to wonder if you've made the wrong choices, made the wrong decisions, or did it not bother you at all? I think from my perspective, at the beginning of the day, I didn't feel very good about it. But then as the day went on, I began to reflect on this idea of dividend growth investing and began to realize that as this market comes down, it's a great buying opportunity. So because of that, as I mentioned last week, I had some extra money that came from various sources. So I decided to put $25,000 into the account and buy some shares on Friday. So we'll go through all of that. So I think the point out of all of this is that when things are not looking good, when there's a lot of red in the market, those are great times to buy stocks, not to sell your stocks. As dividend growth investors, we're similar to firefighters. When there's a fire, most people run from the fire. Firefighters go to the fire and they put the fire out and they help people. We're similar. When we see red, think of red in the market as fire, we kind of go toward that fire, and while most people are running from it. So that's how we're going to win in this market. So if you're a little bit discouraged about Friday's red day, don't be. It's a great opportunity to buy. If you bought stocks that you believe are fairly valued, then there's no change between Thursday and Friday in that fact. So as dividend growth investors, we're going to be a little patient in this one. But as we see opportunities to buy, it's going to be time to buy. And that's what happened on Friday with my portfolio. So without further ado, let's get into it. You can see that on the 6th, 14th, 22nd, and 29th are the days that I bought stocks. This is in the yield account, so these are going to be higher yielding, lower growth stocks. IBM and Main Street Capital I bought on the 6th. Then I actually bought Whirlpool into this account. Whirlpool is typically bought in my growth account because they grow their dividends so quickly. But in Whirlpool's case, they had gotten so low that their dividend yield was 4.1%. I couldn't pass that up as a yield investor. So I pulled some Whirlpool actually into my yield account as well on the 14th. So then some of the normal names that you normally hear from me: Main Street Capital, Prudential, Verizon. And then on the 29th, I also bought Fidelity National Financial. My decision here is to buy a few shares of that and then dollar cost average in over time. I don't know at this point how much is built into the price for the future challenges that will be had in the housing market. But it's a pretty good price right now. So I'm going to go ahead and buy some, and then I'll just add to it over time. If the price continues to go down, I will dollar cost average into that and over time build the position that I want. Also on Friday, I bought some IBM, Main Street Capital Corp, Pinnacle West, Prudential, and Verizon. In the growth account, I bought on the 6th and 22nd some shares of Best Buy and then Microsoft. Then in terms of sales, I didn't sell anything this month. So prices are down. Why would I sell my shares when I just wouldn't be getting as much for them as I want? Dividends, you'll see that it's a pretty light month for me. The first month of every quarter is pretty light. In the yield account, I had 3 dividends. New Jersey Resources at $36.25. Philip Morris at $143.75, and Main Street Capital, my only monthly dividend payer, was at $86. So I had $266 in the yield account. Ended up with 4 dividends in the growth account. I had Merck, which was $91.20, Best Buy $176.61, Comcast at $144.24, and EOG Resources at $153.96 for a total of $566 and 1 cent. in that account. So in total, I got $832.01 in dividends in the month of April. Thought it would be kind of handy to go through this list of dividend increases and decreases. I left everything on there from the beginning of the year, but I do have highlighted here the 5 dividend increases that we saw in April in my portfolio. Johnson & Johnson increased theirs by 6.3% on April 19th. On the 20th, Kinder Morgan went up 2.8%. IBM then went up a whopping 0.6% on April 26th. I joke about that a little bit, but I think that's actually a pretty decent move for them. Hess Midstream went up 6.3% on April 27th. I think it's important to point out also that on January 24th, they went up 1.2%. So Hess Midstream is actually increasing their dividend multiple times, at least so far this year. Apple announced an increase of 4.5% on April 28th. Now, if you've seen my video on the options that turbocharge yield, you'll recognize this spreadsheet, but basically what it does is it gives me what my yield on cost is for a basket of stocks from my portfolio, and it shows me what options transactions have closed and what yield on cost those options created for me to determine my total yield on cost. And I think the important thing here, and I've highlighted a few things, one is that IBM's annual dividend went up a little bit, but secondly, I closed out the options transaction on New Jersey Resources. So instead of a 3.65% yield just on dividends alone, I'm now recognizing a 4.35% yield on this particular stock. So you can see that overall on this basket of stocks, my dividend yield is 4.73. The option yield is 0.25, so I'm nearly at 5% dividend yield. And then I also have entered into some unassigned puts, so I'm getting a 17.6% yield on those assets. One thing I will point out here, though, when it comes to options, the theory here is go low, go slow. It's kind of like cooking a good Boston butt barbecue. I mean, you just want to cook it on low heat for a long time. So if you're looking to get into options, I would say go low and go slow, learn everything you can. And because there are situations like these last few weeks where we have a lot of earnings that are coming in and it's a lot of volatility in the market, and those particular times aren't very favorable a lot of times to options transactions. So I have actually one open options contract, and that is a put on Verizon for $50.50. It expires next Friday, so I'll have to do something with that or end up buying Verizon at $50.50. Then lastly, I'll show you the cash balance. In the yield account, I have $8,081. I have reserved $5,050 for this put on Verizon. So that gives me the ability to invest the remaining $3,000. And as you recall, I put $25,000 in. So that means I put $22,000 of that to work on Friday. Then in the growth account, I have very little. So if you look at my percent of cash to the overall portfolio, it's at a 0.6%. So I'm at a very low cash balance here at the moment. Now let's swing over here to Simply Safe Dividends. I put my portfolios in here. It tracks everything for me. So as you can tell, I've got $27,337 per year in dividend income coming from the investments that I have. That's a yield of 3.33% with a yield on cost of 3.4 and a dividend growth CAGR of 8.6%. Now that's overall. I'll show you both portfolios separately. And the reason I do that is because some of you are more interested in growth and some of you are more interested in yield. I use yield in part of my portfolio to provide income for me, but I still have some assets that I want to grow over time. So I actually have split my portfolio into two. One's a high yield portfolio, and you can see my yield on cost here is 5.26%, and the dividend growth CAGR is still at 7%. So that's pretty good mix there. I will point out here that this week, I went up above $12,000 per year in annual income. So the portfolio that I'm using to help pay for expenses is now above $1,000 per month. So I'm really stoked about that. I think that's really good. Then looking at the growth portfolio, you can see that the annual income there is 14,845. The yield on cost is around 2.6%, where the dividend growth is more, 10.2. It's above a 10% CAGR. Now to walk through the portfolio, I'm going to put these together. I think it's easier for us to do that. I'm going to, I think what I'll do is sort it on gain or loss. Because that can help with these stocks that I think are good buys. Chevron, EOG Resources, AbbVie, Lockheed Martin, Atmos Energy, General Dynamics, and Merck. All of those I'm up more than 20% on, and so pretty happy with all of those. Then, I look at things like Hess. Even Campbell's Soup is 14%. I'm up 14% on Campbell's Soup, which is kind of unheard of. Pepsi, Kinder Morgan, Lowe's, all of those are in decent shape. So what I will do then is go to the bottom and I'll show you the losers. The biggest loser I have on a percentage basis is Comcast. And I do look to get out of Comcast. I'm not going to buy any more of it at this point. So I'm just kind of holding on to it. I wish I'd sold it back when I first decided that I was going to get out of it, but I always thought it would come back, and it has not at this point. So, but I'm still going to hold on to it for the time being. Then I have Stanley Black & Decker. I did a video on that last week if you want to check that out. I do believe that this is a good buy for this company. The 120 range, you can see my cost is 160. The 120 range is really light for them. So if you're looking for a company who has a decent dividend growth, 6% on average, that seems to be beaten down at the moment, I think Stanley Black & Decker is one that you should take a look at as a hot buy from me. And then also Verizon. So if you're looking for yield, now Verizon is not going to grow very fast. You can see that they have a 2% annual growth rate for their dividend, but they are beaten down at the moment. And also their dividend yield is 5.5%. If you're looking for growth, I would also suggest Cummins, which is up here. It's about 9.3% of my portfolio, so it's a bit overweighted for me. But you'll see that they have a 7% average 5-year CAGR, and I think they're pretty well beaten down for this time period as well. Another one that I believe is a good buy is Whirlpool. Whirlpool is sitting at about 182, and my cost is about 197. It also is a pretty high percentage of my portfolio, 7.8%. It's got a 7% growth rate and a pretty decent dividend. So you can get both a high growth and high dividend out of Whirlpool. The other stock I would say is a good buy is Main Street Capital, which is a business development company. They pay monthly dividends. I would say anything $40 or below on them is a really, really good deal. My average cost is $42. You can see that they pay a dividend of 6.4%. The thing to think about, though, in terms of Maine and any business development company, is that if there is a recession and the economy slows down, they may struggle a bit to keep their business model running as it has in the past. But I've looked at Maine, the historical charts on Maine, and they look like they can pretty much weather the storm. It won't be pretty, but I think they can weather the storm pretty well. So if you've gotten value out of today's video, consider smashing that like button. It'll let others know that there's good content inside the video. And if you love talking about dividend stocks and learning more about those, then consider subscribing to the channel and ringing the bell. I would love to have you along for the journey. So as I mentioned earlier, I'm going to put the 6 steps to personal freedom on this side of the screen, and I'm going to put Stanley Black & Decker on this side of the screen. And so if you want to take a look at those videos, that would be awesome. I hope you have a great week in the market this week. But if there's more red, just remember those are great opportunities to buy. So with that, I'll see you on the next video.